Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday, and it's March 20th. We got one item here on the economic calendar, and we will jump right into it. We have the existing home sales for the month of February. So as you can see here in January, we had 5.42 million annualized units for sale or home sales. Forecast increased for it shows an increase for 5.5 or 5.51 and actually jumped higher at 5.77 million annualized units existing home sales. So this is actually a good number here. However, we're going to probably have to disregard it because as of March, we've kind of gone into a new environment, and things that are changing dramatically each day, hour by hour, actually. So as we're seeing new things pop up, which leads us to, we'll go right into the headline news. Stocks were up a bit this morning. Dow was up about 400, but since I've created this report, it's been kind of dropping down further and further, and some indexes are kind of going negative territory. So we'll see if they can maintain this positive outlook here. If they do, it will be the first time in about 6 weeks we've actually had the stock market close back to back in positive territory. We haven't had that in about 6 weeks here. It's been that horrendous for the stock market. Stuff on the agenda today, they've been talking about possible stimulus package that might be rolled out. The GOP are have a proposal that the Senate are sharing with the House, and there might be obviously some changes in it, so we'll have to wait and see what actually comes out of it. But of course, the big part of it is they're talking about sending direct payments from the government to the consumers, people that could probably be using this at this time, which will be probably trying to get to quicker because if you look at this if you heard about this Goldman Sachs report, they're talking that we could see a huge spike in terms of initial jobless claims as soon as next week, approximately as much as 2.5 million people. Our last jobless claim yesterday was at 281,000. Now it's a spike of 70,000. If you look at the credit crisis, probably the highest we saw was around 600,000. So 2.5 million is a pretty substantial jump in there, and this is what's going to concern investors if this comes true. We're also seeing state mandated quarantines around the country. California is the governor's, and same thing with New York, is basically on people to stay home unless you have essential business to be out, to basically stay home, trying to prevent the spread of the virus. They have some very high estimates of people being infected with the virus, and they're trying to, of course, lessen that those estimates of what they're getting right now. So they're requesting people to stay home at this time to again avoid it, and this could be something that could go on for quite a few weeks here as we go through this process here. Let's go ahead and jump ahead here to the bond market. Bond market's not looking so good again. As you see here, we are up about 100 basis points, which looked great, and then all of a sudden, boom, we shifted down, and even we're down 200 basis points. This whole swing was a 300 basis point swing, which translates to 3 points. So this loan here that would have been, if it was up here at no points, now it costs 3 points if it was here. But we end up closing the day down 20 basis points. Right now, we're down about 61 basis points from when we left off yesterday. We're running into a day by day and hour by hour different changes that's going on in this market. Even when the bond market was up here looking pretty good, we had an issue where we had capacity issues, and then so lenders basically raised their rates to try to slow things down. And then, of course, the market started tanking, so you had that double effect on there. Now, because of some comments, I don't think it was anything intentional on his part, but Treasury Secretary Mnuchin, when he made a comment, basically saying that if we don't do something now with the stimulus package, basically we could see unemployment rate jump up to 20%. So that led to investors, especially creditors on the bond market, evaluating their risks in mortgages and stuff. So now we could be seeing them adding risk factors, which could raise the mortgages as well. So we got a lot of factors going into the higher rates that we're kind of seeing that we weren't really accustomed to, just a matter of a few weeks ago. So again, we're running into these situations, and the market's trying to best assess. And the reason why they're worried about that is because it's making them wonder if these people are unemployed, not working, are they going to be able to repay these mortgages? And of course, that might lead to foreclosures and defaults and other negative aspects. And of course, now they're pricing that risk into the mortgages as a result of this. So just be prepared, and also if you guys are in the market, be prepared for uh, a lengthy transaction. We are running into issues where appraisers are having hard times getting into properties due to um, the coronavirus quarantines. Notaries that may come out to be signing your loan docs could be having issues as well. A lot of lenders are basically having their employees work from home, and because it's not may not always be conducive, it may slow them down getting things done as well, especially when they have a ton of files that came in a few weeks ago. If you followed my reports before, we had on a good year, the industry has done about $2 trillion. We had the numbers I'm hearing for this month. They tried putting through $5 trillion of loans this month. That's just kind of unheard of and just overloaded the industry. So this is why they're trying to slow things down a bit, and it's going to take a little time to get this thing kind of developed and get some footing in terms of where there's coronavirus at, and with these low rates and everything else, and trying to get caught up. And so this is going to take a little time to get itself resolved. So just we all need to work together and be patient, and things will get it resolved, but it's going to take some time. So let's kind of move forward here. Let's take a look here at the yields. Yields are also coming down a bit, and they're down to about 0.94, breaking below that 1% level here. This is important as well. So again, and these are also, we had the Fed buying about $100 billion worth of mortgage-backed securities and treasuries today. So we had about 70, I think it was like 74 or 72 or something like that, and like about 32 with the billion of mortgage-backed securities. So it's like a 2-to-1 ratio almost between treasuries and mortgage-backed securities. Treasuries, being the double purchase by the Fed. So if it wasn't for them buying it, this would probably be even worse than what we're seeing right now. Just to kind of give you kind of a gauge as to what we're kind of seeing right now. So sorry for a long video here. Just a lot going on right now, and it's changing day by day and all over the place. Just want to give you a heads up on another scenario. I did talk to one of our non-QM lenders. These are people who are kind of outside the Fannie and Freddie Mac type of loan programs, have a little bit looser, but have guidelines. A lot of those guys are looking at tightening up on a lot of things right now and changing their pricing because the market shifts right now. And they're thinking some of these companies may actually go out of business over the next, maybe by end of this year, due to the market shifts. And if we have people defaulting, these people may not be able to survive. So again, we may be losing loan programs as we go into later this year. So just be cautious as to what's available. So it's really important to talk to your loan officer what kind of loans are available to you at any given time. So and that can change dramatically. So what was something that was available to us yesterday even could be changing today. It's kind of like that environment what we're seeing, and this is a much different environment than we even experienced during the credit crisis, as we didn't have these market shifts as much. We had a lot of losses, but they actually made sense, and the shifts weren't as big as what we're kind of seeing today. So these shifts are unpredictable, and nobody can predict where they're going to go. Some things just simply are not making sense, and just be prepared for what's ahead. All right, folks. I hope you guys stay safe, and look forward to see you guys on Monday's video. If you guys are in California, again, I'm here for you guys. If you guys want to look to buy or refinance and want to talk about mortgages, please direct message me or go ahead and email me. My information is in the red on this. And you guys have a good, safe weekend, and I hope you guys all remain safe. And I look forward to catch you guys on Monday's video. Bye-bye.